cash. For more, let's bring in Dan Gallagher, reporter for the Wall Street Journal, and Mark Douglas, CEO of advertising software firm Mountain. Welcome, guys. Dan, I'll start with you. What do you do with Netflix here?
I think Netflix is going through this pretty painful adjustment. At least investors are readjusting. How are they going to value this business? Because with the the Q1 subscriber forecast that we saw really indicates that growth is going to be slower going forward. And this is a company that's been growing its user base reliably in the 25% range annually, even in the years ahead of the pandemic. And now Wall Street's modeling that's more of a high single-digit number in the years ahead. And so because investors have been so focused myopically on streaming additions, they have to figure out a new way to evaluate Netflix as more of like a revenue cash flow growth story, as opposed to like a fast user growth story. Yeah, in every way, Mark, it seems like Netflix is maturing. Its PE is way down from what it used to be. At last check, it was around 35. It faces competition. It's a mature business now. But what happened with this most recent stretch? I mean, why do you think all of a sudden they're having a hard time adding as many subs as they expected?
Well, I think it's really simple. Everyone has access to Netflix. And so, I mean, it's literally hard to find someone who doesn't have a Netflix account or have access to one. But that's actually an opportunity for the business. That for years, they've been encouraging sharing of accounts, but the company can slowly start to essentially make that more difficult and drive more subscribers. And I think one thing that hasn't been explored for Netflix at all, but they really should consider, and there have been rumors of it, which is to have an ad-supported offering, so they can go beyond the 70% market share they have into really the corners of the market and get every single entertainment consumer.
I also thought, Mark, it was interesting that you're warning a little bit about this idea that, yeah, it's a hit-driven business, and so Netflix is going to keep coming out with these great shows, and that'll drive subscriber growth. And what worries you about this model?
Well, I think that the thing that's interesting about Netflix is hits come and go. It's 10 episodes a year for anybody, for HBO, for Hulu, anyone. But then you as an entertainment consumer, you're looking for what to watch. And that's the space Netflix dominates. It's the time, the entertainment time between hit shows, both on Netflix and in other worlds. And that's why they actually really dominate this market, I think, in a way that no one else does. And I think them becoming hit-driven is actually not healthy for the business. They want to continue to be the go-to choice every night of the week, not just when your favorite show is on.
I guess, Dan, they were by default in the past because they were kind of the only game in town. But there are other streaming services that you can linger on. The famous joke about Netflix is you spend half an hour watching nothing, right? Just kind of poking around.
For sure. And I think, and I wonder also if we're going to see the company reevaluate some of how it releases content too, because Netflix is now one of the few streamers left that's like that does a dump. When they have a new series, it all comes out every episode. And all the major ones, Apple, Disney, HBO, those come out, episodically. And I think the benefit of that is that people that really want to watch those are sign on for longer periods. And you're getting to a point where if there's one or two shows you like on Netflix, you can essentially sign up for a month, when that show hits, watch it all, and then you're done. And I think Netflix might want to reevaluate that going forward. We'll see. But they might be looking at a lot of options here for how to kind of address this new phase they're in.
Yeah. Turning to Peloton, Mark, before we go, I have to ask you, you kind of rode to the rescue last time with Ryan Reynolds and Mr. Big after that Sex and the City episode killed him off. You guys had this really fast creative as a service ad where you said, no, forget it. I'm still here. Everybody's okay. What do you do now?
Yeah. Well, look, Peloton has a healthy business. I mean, figuratively and literally, they're in the fitness market, and I think fundamentally everybody else in that market would love to have the Peloton brand. So they have the brand, they have a product people love, and I think that's a strong point for them to go forward from. I think they could come down market in terms of price points and product, and just kind of get back to basics, and the company will do fine. I would personally, I'm a big fan of Peloton. I use the product, and I think the stock is great in the long term.
Should we expect any other fun ads in the near term, or you think they're kind of beyond that right now?
I think right now we're not creating any ads for Wall Street analysts, so there's nothing coming out today or tomorrow.
Fair enough. Again, it's been such a difficult little stretch for them. We thank you guys for joining us today. Mark Douglas and Dan Gallagher talking about the growth troubles for both Peloton and Netflix.